Welcome back to this video. In this video, I'm going to be sharing with you what forex trading is and everything you need to know about forex trading. And also, we are going to move further to explain to you how you can analyze the markets as a forex beginner. So just stay with me in this video. Make sure to get a writing material, and without further ado, let's just get straight into the video. Firstly, we need to know what forex trading is. Now, in a very simple form to explain forex trade or foreign exchange trading is the act of buying and selling currency on the foreign exchange market with the aim of making profits. That is just the simple explanation for forex trade. It's the act of buying currency in the foreign exchange market with the aim of making profit, because nobody takes a trade with the aim of taking a loss. Now, there are some key concepts of forex trading. The first one being currency pair. Currency are traded in pairs such as Euro USD, which is the Euro and the US dollar. Remember now, in forex trade, we are talking about currency, different countries' currency. Or JBP JPY, which is British pounds / Japanese yen. The first currency in the pair is the base currency, and the second is the quote currency. Pay attention to that. The number two concept is exchange rate. This is the rate at which one currency can be exchanged for another. For example, if the exchange rate for Euro USD is 1.20, it means 1 euro can be exchanged for 1.20 US dollar. Number three, bid and ask price. The bid price is the price at which the market is willing to buy a currency pair, while the ask price is the price at which the market is willing to sell it. The difference between the bid and the ask price is known as the spread. Also take note of that. The difference between the bid and the ask price is also known as the spread. Number four, leverage. Forex brokers often offer leverage, which allows traders to control a larger position than what they could with their own capital alone. For example, with a leverage of 100 to 1, a trader can control $100,000 with just $1,000 of their own money. Now, this leverage of a thing, don't be fooled by it. It will favor you in a good way, and it can also go against you. So it allows you to participate in the market with larger amount of money, which means you can take trades that if the market is going in your favor, you make a lot of money. Vice versa, if the market is going against you, you will lose a lot of money with this power of leverage. Number five, we have pips. A pip is the smallest price in a currency pair. For most currency pair, a pip is equivalent to 0.001 of the quote currency. Remember, in number one, we said that the second currency is the quote currency, while the first one is the base currency. Margin, which is number six. This is the amount of money required to open a leverage position. It is a portion of the trader's account balance set aside by the broker to cover potential losses. Now, when you start trading, when you start analyzing and taking trades for yourself, either a demo account or a live account, you understand what this margin means. This margin literally tells you the number of position you can place with that particular lot size you use in taking the trade. So when it says that is the balance set aside by the broker to cover potential losses, that does not mean it's the amount of money you will lose. If there's no stop loss, the market will take more from you. And also, if you take a trade, you might see margin that is lower than that's a lot more lower than your stop loss, or a lot more higher than the amounts you are seeing in your stop loss. The amount you are seeing in your stop loss, that's the amount you will lose on that trade. The amount you are seeing on the margin, That is the amount of the number of trade you can place using that particular lot size. Let's say, for example, you use 0.1 to take Nasdaq trade, and then on your margin, you are seeing 5, or let's say you are seeing 5. It means that you can place 0.1 into 5 places on that Nasdaq trade. You can use 0.1 and place 5 position. You understand it more better as you go into the trading arena. Number 7 is the long and short position. Going long means buying a currency pair in anticipation that its value will increase, while going short means selling a currency pair with the expectation that its value will decrease. This is as simple as what forex trading is. You are either buying or you are selling. That is the only way you make money from the chart. Number 8 is technical and fundamental analysis. Traders use analysis, analyzing past price movements and patterns, and fundamental analysis, evaluating economic indicators and news events to make trading decisions. Now, take note here, if you are a technical analyst, you need to be a lot more better at one and slightly better at the other. So if you are good at technical analysis, you need to be slightly better at fundamental analysis, because both of them work together. Both of them need each other to survive. So you cannot be good at one and neglect the other. Number 9 is risk management. Now, the only way we can talk about risk management is when you start trading an account, being it a demo account, a live account, or a prop firm account. So you can only start talking about risk management when you actually have an account, and when you've actually know what you are doing, which means you've known how to analyze the market to some extent to even take trade, and then you can start talking about risk management. But let me just explain what risk management means to you, at least just to bring you in the beginner sense of what risk management. Effective risk management strategies such as setting stop loss orders and position sizing are crucial in forex trading to minimize potential losses. Now, this is just the definition. It's a lot more wider than this, but we'll get into that as you start trading an account. How forex trading works. Number 1, choosing a broker. Now, for some of you who don't know what a broker is like the bank that connects you to your trading platform. A broker is where you deposit money. A broker is where you make your withdrawals. So, and one of the best broker that I've ever seen and that I've been using for a very long time now is SNES. They have a very tight spread. You can deposit quickly, almost instantly, withdraw your money almost instantly. So if you want to use SNES, the link is in the description below. They are a very good broker and they are very smooth and very safe. Number 2, opening and funding an account. Traders open a trading account with the broker and deposit funds. Number 3, place trades. You can only make money from the chart if you are placing trades. You can stay at the market for 70 years and then the market will not do anything to you, and if you don't do anything to the market will just keep doing its thing. So you have to place trades, either buy or sell, in order to make money, and also in order to take loss, because if you're not participating in the market, then you don't stand a chance of either making money or losing money. Number 3, traders place trade through the broker's trading platform. They can go buy, which is also means go long, or sell, which also means short, currency pair, based on the analysis. Now pay attention to that word. Whatever you do on the market is based on your analysis, not based on what you think or based on what you feel or based on what you suggest. It's based on your analysis. There has to be a map, a detailed roadmap to why you take that trade. So it's based on your analysis, and we'll get to the analysis part as we move on in the video. Number 4, monitoring and closing trades. Traders monitor their positions and make markets movements. They close trades to realize profits or cut losses. Forex trading can be highly profitable, but also involves significant risk due to market volatility and leverage. It requires a good understanding of the market, effective strategies, and risk management. Forex trading can be very, very difficult and frustrating, but if you just stay consistent long enough, if you are able to stay consistent long enough, then being a profitable trader is guaranteed. Nobody was born a profitable trader. They have to learn it. So if they can learn it, you also can learn it. Types of charts in Forex. In Forex trading, various types of charts are used to analyze and predict market movements. Each chart type provides a different way of visualizing price data, helping traders make informed decisions. Here are the main types of charts used in Forex trading. Number 1, we have the line chart. Now, the description of the line chart. A simple chart that connects closing price of a currency pair with a continuous line. The use of the line chart. Idea for getting a quick overview of the general price movement over a period of time. It's less cluttered and helps in identifying overall trends. This is one of the use of the line chart. It helps you to identify the overall trend very easily. It's very easy. As soon as you just set it to line charts, just by looking at the price, you can say this market is doing this and this market is doing that. Now, the limitation of the line chart lacks details as it only shows closing price, missing out opening high and closing lows and closing price. You see, that's some of the limitation of the line chart. Number 2, we have the candlestick chart. The description of the candlestick chart. Similar to bar charts, more visually opening and easier to read. Each candlestick shows the opening, close high, and low price for a specific time period. You can see here that this image we have this bearish candle, low, high, close, open. It's open at the bottom. Don't worry, as we move on, I'll explain it to you more better. The component of the candlestick chart. What are some of the components of the candlestick chart? 1 is the body, the rectangular area between the opening and closing price. 2, wicks/shadows. You can call it wick or you can call it shadows. Line exceeding from the body indicating the high and low price. Color, typically green or white for rising price, close to open, and red or black for falling price, close/open or close to open. Now, don't let the color fool you. You can change your color to anyhow you want. So if you look at other traders' charts, their color might be green and black and yellow. So the color does not really matter. You just have to know the bullish candle and the bearish candle. That's all. So don't let the color fool you. It does not have to be green and red. Use. Widely used due to its detailed and clear representation of price movements. Candlestick patterns can indicate potential market reversal or continuation. This is one of the benefits and one of the reasons candlestick charts is widely used by a lot of traders. It gives you details of the market. It literally gives you details of what the market is doing. The continuation pattern is give you patterns. It's very, very clear to understand than the line chart. And some of the limitation requires understanding of various candlestick patterns to fully utilize its potential. So some of the limitation of the candlestick chart is that you have to understand a lot of the which means each of the candlestick pattern you have to understand at least a lot of them in order to use the candlestick charts to its full potential. So with that, we move to market trends. Forex market trends can be broadly categorized into three main types. We have the uptrends, the downtrends, and the sideways trends. Each type reflects the general direction in which a currency pair is moving over a certain period. Understanding this trend is crucial for traders to make informed decisions. Here are the details. Number one, we have the uptrend. The uptrend, which can also be called the bullish trend. What are the characteristics of the uptrends? Higher highs and higher lows. Now, as we go further into the video, you need to start paying attention because we are going deeper and I'll be saying a lot of things that may sound complicated to you. But if you just pay attention and listen very carefully enough, you will understand it. The next one is the indicator. Rising moving average, bullish candlestick patterns increase buying pressure. Number 3, trading strategy. Traders look for buying opportunities aiming to enter position at pullbacks or support levels within the uptrend. So in an uptrend, you are looking to buy the market or you are looking to long the market. Remember, long also means buy, while short also means sell. So this is an example of an uptrend. This is an example of an uptrend. The market creates higher highs and higher low, an uptrend. And take note, in an uptrend, you are only looking to buy or long the market, which is the same. You are looking for buy, which also means long. So you will be buying from support. Don't worry, when we get into the analysis, we analyze it more better and then you understand it. The next one, which is number 2. This is number 2. Number 2 is downtrend or bearish trend. Characteristics: lower highs and lower lows. Indicators: falling moving average, bearish candlestick patterns increase a selling pressure. Trading strategy: traders look for selling opportunities aiming to enter position at rallies or resistance level within the downtrend. Now, in a downtrend, the market creates lower highs and lower low, while in a uptrend, it creates higher highs and higher low. Now, the third one, which is number 3, is a sideways trend, range bound or horizontal trend. Now, this is also known as a consolidation. So when a trader says the market is consolidating, it also means the market is going sideways, horizontal trend, or range bound. Characteristic: price move within a defined range, neither making significant higher highs nor lower lows. Indicators: flat moving average, oscillators like RSI or MACD, fluctuating around the middle level, frequent reversal at support and reversal level. Trading strategy: traders look for buying at the lower boundary of the range, Personally, for trading strategy, I will say you just stay off the market. If the market is consolidating, just stay off. Because if you are trying to cash the consolidation and make some quick profits from it, you might actually end up losing your money. Now we move to the factors influencing forex market trends. This factor is influencing forex market trends. We have the economic data. Remember that at the beginning of the video, we talked about two types of analysis, which is the fundamental analyst and the technical analyst. Now, the fundamental analyst focus on economic data, monetary policy, geopolitical events, market sentiment. These are some of the things that the fundamental analyst focuses on. So, factors influencing forex market trends. We have the economic data, indicators such as GDP, employment rates, and inflation figures. These are some of the things that influence the market, which makes the market to move up or go down. We have the monetary policy, central bank decision on interest rates and quantitative easing. We have the geopolitical events, political stability, trade negotiation, and global crisis, maybe war, non-employment, just anything happening around that particular country. Now, here is another thing you need to understand. Anything that is happening in the US, which means the United States, will affect the US dollar a lot more than the Japanese yen. So the effect or the crisis that affects that particular country will affect its currency a lot more than any other currency. So pay attention to that. So not everything that is happening around the world will affect all the currency. By recognizing and analyzing these trends, forex traders can develop strategies to capitalize on market movements, whether through trend following or counter trend approach. And lastly, we move to types of candlestick pattern. Candlestick patterns are visual representations of price movements in a specific time period and are crucial in technical analysis. Here are the main types of candlestick patterns used in trading. Now, when you get into trading, you will understand a lot of this candlestick more better. But let's just go through them. The single candlestick patterns. One, we have the doji. Indicate indecision in the market. The open and close price are almost identical. Here I actually put in a bullish engulfing candlestick. This is not a picture of a doji candlestick, but I'm going to show you the picture of a doji candlestick. But this one is for bearish engulfing. I will also explain what bearish engulfing means. Number two, this is supposed to be number two, is hammer. A bullish reversal pattern with a small body and a long lower wick occurring after a downtrend. Now this is how the hammer candlestick look like. So you have the long wick and you have this thin body. So it's just similar to your regular hammer. Then we have the inverted hammer. Just turn it upside down, flip it, then you have the inverted hammer. The hammer is mostly seen in a uptrend, while the inverted hammer is mostly seen in a downtrend. Because you can see the selling pressure pulling the market down and the buying pressure pulling the market up, creating this wick or shadow. And then the next one we have the hanging man. We have the hanging man. A bearish reversal pattern with a small body and a long lower wick occurring after an uptrend. Now, the hanging man is similar to the inverted hammer or the hammer, but the little difference is that you have the small wick at the bottom, small body, and then you have big wick at the bottom. So that's the difference. And then number 3, which is this one, we have the inverted hammer. This is the same picture you see on the side of the hammer. A bullish reversal pattern with a small body and a long upper wick occurring after a downtrend. Then the next one, we have the shooting star. We have the shooting star, a bearish reversal pattern with a small body and a long upper wick occurring after an uptrend. Then next one, we have the Marabuzo, a candlestick with no wicks indicating strong bullish or bearish sentiment. Now, among all these candlesticks, I only have 2 favorite ones, which is the bullish engulfing or the bearish engulfing, which is this one. The bullish engulfing candlestick or the bearish engulfing candlestick. A bullish engulfing, a smaller bearish candle is followed by a larger bullish candle that engulfs it. So you have this red one representing bearish candle, while this bigger one representing bullish candle. So when it says bullish engulfing, it means that the bullish candle, which is the green one, remember now I said the color might be different, so don't be fooled. The bullish candle, which is in this picture is the green color, is bigger than the bearish candle, which is the red one. So these 2 candlesticks are my favorite, the bullish engulfing or the bearish engulfing. And sometimes I still use morning star or evening star, but my favorite one is bullish and bearish engulfing. So take note of that as well. Then we have the morning star. This is also my favorite. The morning star candle stick pattern is a powerful bullish reversal pattern that signals the end of a downtrend and the potential start of an uptrend. It consists of 3 candles and is highly regarded by traders for its reliability in predicting market reversal. Now, just like I said, when you go into the chart, you start seeing, we'll go into the chart and then we'll find all these candlesticks we have talked about. We'll find them on the charts, then we see how we can utilize them and make trading decision based off this candle. Components of the morning star: first candle, bearish; second candle, indecision candle; 10th candle, bullish candle. Now, the morning star is for the morning star is for when you are buying, like that. Let's see. First candle is powerful bullish reversal pattern that signals the end of a downtrend. So the morning star is when you are buying, and also we have the evening star is when you are selling. Interpretation and trading strategy. Confirmation. Now, this is what a lot of traders don't pay attention to. If the market has reached your entry or your POI, which is your point of interest, always wait for an extra confirmation. It helps you avoid trades that will go in loss. It just helps you avoid most of them. So confirmation candlestick is very, very important. And for my confirmation candlestick, I like using the bullish engulfing or bearish engulfing, or really the morning star or evening star. Those 2 are my favorite candlestick patterns. Entry points, which is number 2. Traders typically enter a long, which is for the morning star now, position at the close of the 10th candle or at the opening of the next candle. So you can go through this, take note of this. Take profit, the take price can be set based on nearby resistance level, previous high, or using a risk-reward ratio. Now, this is another session entirely of the whole video. This is another session. we have the smart money concept, which is SMC. This is a strategy you will use in predicting the market, either going long, going buy, or staying off. Because also not trading is also a strategy. So you know when to enter the market, when to exit the market, and when not to trade at all. This strategy is known as smart money concept, SMC. This is a very popular strategy among traders. If you master this strategy, trust me, you are going to avoid a lot of headache in the market if you just master the act of trading SMC concept. In forex trading, SMC often stand for smart money concept. This trading strategy focuses on understanding and following the actions of smart money, institutional traders, banks, and large financial entities that have significant market influence. Smart money concept involves several key principles. Now we are going deeper now into the principle of smart money, so you really need to start paying attention now. The first one is market structure. As soon as you start trading smart money, you need to understand market structure. Understanding the overall market direction and recognizing key levels of supply and demand. Now, in this picture, you can see we have accumulation, trend up, supply zone, distribution, reaccumulation, and then we have trend up. This is how the market moves. It consolidates, which is it moves sideways, accumulating price, and then you have an impulsive movement either to the upside or the downside, and then it consolidates again, you have an impulsive movement. That's how the market works. It consolidates, have an impulsive movement either to the upside or downside, consolidate again before going for another impulsive movement. That's how the market works. Number two, you have liquidity. Now, this is one of the reasons why I love using the SMC strategy, and the SMC strategy has been one of the greatest strategy that I have used, because I've used some other strategy. Now, SMC strategy help you to find liquidity levels, liquidity area in the market, because you need to understand that the market moves by liquidity. The market moves by taking liquidity, scooping liquidity, filling orders, taking stop loss, taking people take profits, orders or levels. So liquidity is a very crucial area or crucial levels or crucial topic to know in the market. So number two, identifying areas where liquidity is pulled, such as around previous highs and lows, where smart money might be executing trade. When we go into the chart, I will explain this a lot more. So pay attention. And then number three, we have order block. These are the concept of smart money. Number three, we have order block. Recognizing areas where institutions traders have placed large orders, also seen as zone of price consolidation before significant moves. That's the meaning of an order block. This is what an order block looks like. Or in other words, you can say order block is the last opposite candlestick before the impulsive move. Make sure to take that word down. Order block is the last opposite candlestick before the impulsive move. Now, when I mean last opposite candlestick, this is the last red candle. It does not have to be red. Remember, this is the last bearish candle before this bullish impulsive movement. So you can say order block is the last opposite candle before the impulsive move, because the impulsive move can also be for a sell. Now let's see the definition of order block. Order block, which is OB, also known as OB, are footprints left by the market when an impulsive move occurs. Order block, OB, is the last candle before the strong move that creates an imbalance in the market. Number four, we have imbalance. Imbalance / FVG, also known as fair value gap. So You can call it imbalance, fair value gap, or FVG for short. Supporting gaps between candlesticks where the price moved rapidly, indicating potential areas where smart money entered the market. Now this is what a fair value gap diagram look like. We have three impulsive candles, and then this week and this week, the space between this week and this other week is known as the imbalance, FVG, or fair value gap. The space between this week and this week. So fair value gap is mostly spotted within three candlesticks. Three candlestick is where you find, in between three candlestick is where you find fair value gap. So the beginning of this week to the beginning of this week, the space between them is known as the FVG, or fair value gap, or imbalance. I can also say imbalance. Inducement: recognizing traps set by smart money to induce retail traders into taking positions which smart money then moves against. Now, as you go further and better into knowing what smart money is, which is MCMC, you go into the advanced level, you understand a lot. There is a lot for you to understand. So that's why in the video section, whereby we go to the charts and analyze and find out this fair value gap, order block, equal highs, swing high, swing low, everything you have learned here, we'll go in the charts and try and identify them, explain them so that we can understand them more better. So SMC is very, very broad, but the deeper you go, the more you love it and the more you enjoy it. So just try to enjoy the entire process. Now, lastly, as we come to the end of this video, which is end of this session, using SMC involves combining these elements to anticipating where the markets might move next, based on the assumed actions of institutional traders. This approach often requires in-depth analysis and a good understanding of market mechanics. So that is it for the basics of forex trading. Now, in the next session, we'll move to the chart to get a better understanding of everything we've talked about in the basics of forex trading.